Welcome back to the Deep Dive. Today, we are strapping in, really, to examine one of the biggest financial disasters, certainly in recent memory, the collapse of the U.S. subprime mortgage market.
Yeah, it's a huge one. But we're not just, looking at the disaster itself. We're following this small, kind of weird group of financial outsiders.
Right, the ones who didn't just predict it, they actually bet their fortunes on the system collapsing.
Exactly. It's really a story about institutional arrogance, financial absurdity on a massive scale, and just this incredible denial of risk.
And our sources for this, mainly Michael Lewis's work digging into it, they paint this picture of finance becoming, well, just totally detached from reality, right?
So detached, so leveraged, so kind of self-delusional that it really took people on the absolute fringes outside the consensus to even see what was happening.
Which actually brings us right to the hook Lewis uses. He calls it the unbearable preposterousness of finance. It's perfect.
Yeah, he talks about his own start on Wall Street back in the 80s. He's, 24 years old?
No experience, knows nothing about finance.
Right, and he's making these huge multi-million-dollar bets with other people's money. Just like that.
And he kept thinking, surely there has to be some kind of great reckoning, right? Some consequence for all this excess.
But it just didn't come, not back then anyway. And when he wrote his first book, Liar's Poker, about that whole 80s scene.
He meant it as a warning, didn't he? Like, look how crazy this all is, a period piece.
Exactly. A cautionary tale about greed running wild. He thought people would be, appalled.
But the big irony, the twist, is that all these ambitious college kids read it completely differently.
They read it as a how-to manual, seriously. They saw the excess not as a danger sign, but as, the roadmap to getting rich.
Which just sets the stage perfectly for the next disaster, doesn't it? Because the whole moral compass had shifted.
Totally. By the early 2000s, Lewis points out, the absurdity wasn't just bigger, it was, exponentially bigger. Think about this. In 1986, the CEO of Salomon Brothers makes $3.1 million. It's a public scandal, documented, people are outraged.
Okay. Seems like a lot for back then.
Right. Fast forward 20 years. A single bond trader, this guy Howie Hubler we'll get into later, loses over $9 billion on one trade.
$9 billion with a B.
$9 billion. And Lewis says he remained, quote, essentially unknown to the public.
That's staggering. The scale is just completely different. It's not just bigger numbers.
It's like the system's ability to just absorb and hide catastrophic failure got so advanced that it became normal.
Yeah.
Invisible, almost.
A loss that big used to be front page news, congressional hearings. Now it's just a rounding error for the bank.
Pretty much. It speaks to this profound psychological shift, The numbers stopped being real. A 9-figure loss wasn't a personal disaster for the trader anymore. It was just like a technical problem for the corporation to manage.
Okay, so if the whole machine was running that hot, that blind, what was the first sign? The first, audible crack that maybe this whole thing was about to go off the rails?
Well, Lewis points to this really unlikely figure, actually. A woman named Meredith Whitney.
Okay, who is she?
In 2007, she was a pretty obscure equity analyst, covered the big banks for Oppenheimer. And in October 2007, she goes public.
And says what?
She predicts that Citigroup, a pillar of American finance, was in such bad shape it would have to slash its dividend, maybe even face insolvency.
Why? What was the problem?
Because of all the, and this is her quote, crappy assets they're holding with borrowed money, specifically subprime mortgage stuff.
Wow. What happened when she said that?
Citi stock tanked, dropped 8% in one day, wiped something like $400 billion off the total market value. She became instantly famous, or infamous, depending on who you ask.
But her critique wasn't just about bad assets,
well,
right?
Yeah.
It was deeper than that.
Exactly. That's the key thing. She wasn't saying the bankers were just corrupt, cooking the books. She was saying they were, stupid, fundamentally incompetent.
They didn't even understand their own business.
They didn't understand their own balance sheets. They were completely failing to recognize billions in losses from these subprime mortgage bonds they thought were rock solid. It wasn't just a lie to the public. It was like they were lying to themselves. A profound misunderstanding.
So Whitney's call in late 2007 kind of rings the alarm bell.
Yeah.
And that gets Lewis thinking. If she saw it then, who saw it coming way earlier?
Exactly. Who were the real prophets in the wilderness? Before the whole casino caught fire, who noticed the roulette wheel was, rigged?
That's the mission here, right? Finding those outsiders.
That's our deep dive. We're looking for the people who saw the flaw in the code, the value investors using math, the kind of moral crusaders fueled by outrage, the quants who saw it as just a really cheap bet on disaster.
All right, so let's start with the first one, the isolated mathematician, Michael Burry. His story is maybe the most unique because his supposed quirks turned out to be his biggest strengths here.
Yeah, Burry was the ultimate outsider. Temperament, background, everything. He'd been a medical student, neurology resident, actually.
But he didn't stick with medicine.
Found it either incredibly boring or kind of disgusting, according to Lewis. So he taught himself finance, strict value investing, Graham and Dodd style. And crucially, he has Asperger's syndrome.
And the source material really digs into how that specific psychological profile was almost perfectly suited for this kind of financial detective work.
Totally. Think about the traits associated with it. He found face-to-face interaction really difficult, apparently took things very literally, missed social cues, stuff that greased the wheels on Wall Street.
So he avoided that.
Preferred to communicate entirely in writing. Emails, memos. That's where his pathological focus and analytical brain could just take over. He had this obsessive need to find the objective truth buried in the data without the ambiguity of conversation.
And that focus is what let him do what basically no one else was willing to do.
Which was?
Actually read the prospectuses for these mortgage bonds. Thousands of pages of incredibly dense, boring stuff.
Exactly. His aversion to social ambiguity, that intense focus, it let him plow through financial documents that everyone else, including the people buying the damn things, just ignored. He said later, only someone with his neurology would even bother.
He was imposing logic on a system that was running purely on sentiment and herd mentality.
And he had this intense obsession with fairness, too. Lewis tells that story about him stopping watching basketball.
Oh, yeah, because he thought the refs favored the star players.
Right. He couldn't stand what he saw as systematic unfairness, which, kind of primed him to spot the systemic unfairness baked into the bond market. That sense of outrage was a big driver.
So he starts looking beyond just stocks. He has this big realization around 2003.
Massive realization. It shifted his whole focus. He'd mostly ignored the bond market, like most equity guys.
But then he sees it's actually the key.
He has this epiphany moment, quote, "The fixed income world dwarfs the equity world. The equity world is like a fucking zit compared to the bond market." Just the sheer scale of mortgage debt meant that basically every financial company was exposed, directly or indirectly.
And this bond market was much more opaque than the stock market.
Totally. Less regulated, way harder to see what was actually going on inside these bonds.
So what was his specific diagnosis? What was the core problem he identified?
He called it extension of credit by instrument. This is really key. The old way of lending had limits, right? Credit standards. If you couldn't afford the loan, tough luck.
But Wall Street changed the game with the originate-to-distribute model.
Exactly. Lenders didn't care about the borrower's ability to repay anymore because they weren't holding the loan. They sold it off immediately to Wall Street to be packaged up.
So their incentive was just make more loans. Volume over quality.
Precisely. Burry saw lenders were constantly degrading their own standards to grow loan volumes. And how did they do it? By inventing ever more complex, often predatory financial products.
Like adjustable rate mortgages with low teaser rates, low doc loans.
All that stuff. Products designed specifically to lend money to people who absolutely could not afford a traditional mortgage. The instrument itself was the mechanism for extending credit where it shouldn't exist. He figured the people buying these bonds at the end of the chain had to be, quote, dumb money.
Okay, so Burry sees this whole structure is built on sand, basically. It's doomed. But how do you bet against it? That was the tricky part, right?
That was the genius move. You couldn't short sell mortgages individually. You couldn't really short the mortgage bonds themselves. Effectively, they were too fragmented, illiquid. The market just wasn't set up for betting against these things.
So he had to kind of invent the weapon.
He basically nudged Wall Street into creating it for him. He started asking around, pushing banks to create credit default swaps, CDSs, specifically on subprime mortgage bonds.
Which is basically just insurance.
Exactly. It's an insurance policy. Burry would pay a premium, and the bank on the other side, the seller of the insurance, promised to pay him the full value of the bond if a certain percentage of the underlying mortgages defaulted.
And he figured the banks would sell him this insurance?
Yeah, his insight was partly technical, partly psychological. He figured the big banks selling the CDS were either too arrogant, too ignorant of the actual risk in those bonds, or just too hungry for the steady premium payments he was offering to say no.
And this is where his intense focus really paid off. He didn't just bet against all subprime, he targeted a very specific slice.
He zeroed in laser-like on the bonds backed by mortgages originated in 2005, particularly the BBB-rated slices, the riskiest ones.
Why 2005 specifically?
Pure logic. Those loans almost all had those 2-year fixed teaser rates, so a loan made in early 2005 at, say, 6%.
Would jump to maybe 11% in early 2007?
Exactly. The payment shock would be huge. He saw a massive wave of defaults coming, timed almost perfectly for 2007. It was like a ticking time bomb built into the loan structure itself.
So he places his bets in 2005, pays the insurance premiums for 2 years.
Right, listening to that faint ticking sound, as Lewis puts it, waiting for it to get louder.
And the big Wall Street banks he bought the CDS from, they thought he was nuts.
Oh, they loved him. Goldman Sachs, Deutsche Bank, Morgan Stanley. He approached several, carefully avoiding the ones he thought were most exposed, like Bear Stearns and Lehman, which was smart.
Why did they love him?
They saw him as free money, this eccentric guy betting on, like, financial Armageddon. Highly unlikely, right? They were booking his premium payments as pure profit. They were tossing around $100 million CDS trades, like pocket change. Lewis quotes someone saying it was like, it's 3 digits instead of 9.
That dismissal must have just confirmed Burry's whole thesis for him. They really didn't get it.
But making the bet was one thing. Holding onto it for 2 years while paying out millions in premiums and having everyone doubt you.
Wow.
That created huge problems for him internally.
With his own investors.
Yeah, this is where it gets really stressful. His investors were mostly traditional stock guys. They did not trust his ability to make these huge macro calls. They kept asking, why are we paying Goldman Sachs millions for insurance? They're happy to sell us. This is crazy.
They just saw the money going out the door on this seemingly impossible bet.
And he had to keep explaining the structure of the CDS. He wasn't betting on total collapse necessarily. He just needed a small fraction of these really awful mortgages to default. And the payout would be enormous because the insurance paid 100 cents on the dollar once the trigger hit.
But the banks selling the insurance, they controlled the marks, right? The day-to-day valuation of his CDS contracts.
And for almost 2 years, they refused to mark them up. Even as the housing market started showing cracks, they just kept marking them based on their flawed models, basically pretending nothing was wrong.
Which put Burry in a terrible position with his investors.
Terrible. By 2007, his investors were panicking. They wanted their money out, but Burry couldn't easily sell the CDSs, and the banks weren't valuing them properly anyway. So they staged this kind of run on the fund, demanding redemptions.
What did he do?
He had to impose a gate, basically locking up their money to prevent them from forcing him to liquidate the position just before it paid off. It caused immense personal stress, lawsuits. He eventually resigned and closed his fund, Cyan Capital, right after the trade finally came good.
So he won the bet, made fortunes for the investors who stuck with him, but it almost broke him.
Yeah, it showed that pure, isolated logic could beat the system, but the psychological pressure of being that far outside the consensus was just immense.
Okay, so Burry was the mathematician, driven by logic and data. Now let's shift to Steve Eisman and his team. Their approach seems almost opposite, driven by skepticism, moral outrage.
Yeah, Eisman is a totally different character. His background was Oppenheimer, trained by his parents, actually, who were old-school value investors. Oppenheimer had this kind of counterculture vibe, always skeptical of the big Wall Street firms.
And Eisman himself had this reputation for being confrontational, brutally honest.
Absolutely. Zero tolerance for bullshit, basically. Financial jargon, deception, he just cut right through it.
Like that story about the Japanese company's financial statement?
Oh, yeah, classic Eisman. He couldn't read Japanese, gets the statement, holds it up to his translator and says, basically, tell them this. This is toilet paper. He demanded that level of bluntness.
And his team kind of adopted that same core skepticism. His head trader, Danny Moses. What was his go-to question?
Whenever a broker came in pitching a trade, Moses' first question was always, how are you going to fuck me? Seriously. He wanted the broker to explain the downside, the hidden risk, how the trade could blow up in their face before they'd even consider it.
They weren't just looking for the upside. They were actively hunting for the flaw, the built-in betrayal.
That was their whole philosophy, proactive skepticism.
So when did this skeptical crew first run into the subprime mess?
It started with one of Eisman's junior guys, Vincent Daniel, or Vinny. He was digging into the subprime originators, the companies actually making the loans.
Trying to figure out who was going bankrupt first?
Kind of. But the originators were cagey. They wouldn't disclose delinquency rates, claiming, hey, not our problem, we sold the loans to Wall Street, that whole originate to distribute thing.
Passing the hot potato.
Yeah.
But Vinny found something in the data.
He looked closely at loans for manufactured housing mobile homes. Now, mobile homes usually go down in value, right? So people rarely refinance them.
Yeah.
But Vinny noticed really high prepayment rates on these mobile home loans. He realized it wasn't refinancing, it was involuntary prepayment.
Meaning default and repossession.
Exactly. The lenders were taking the homes back. He started seeing these stunningly high delinquency rates, hidden in the data, across all sorts of subprime pools. High enough to show the whole business model was basically a fraud, needing constant new loans to paper over the losses.
And this wasn't Eisman's first rodeo fighting this kind of stuff, right? He'd gone after household finance years before.
Right. The household finance crusade in the early 2000s is really important context for Eisman's mindset. He saw them using deceptive sales pitches, like hiding a 12.5% rate and calling it a 7% effective rate, just blatant fraud targeting vulnerable borrowers.
And he didn't just short the stock. He actively campaigned against them.
He rallied activist groups like Acorn, got local reporters involved. He was driven by this real moral outrage.
What happened when he pushed regulators to act?
The pushback was telling. Regulators basically said household was too big, too powerful, and besides, who else would make these kinds of loans if they shut them down?
And Eisman's response.
Classic Eisman. He shot back, believe me, there will be a train full of people coming to lend money. His view was, get rid of the crooks, and honest capital will step in. It cemented his view that the subprime market, left unchecked, was ethically bankrupt.
Okay, so Vinny's data showing defaults, Eisman's history of moral outrage. That sets the stage for this key meeting in 2006.
Yeah, late 2006, this Deutsche Bank trader, Greg Lippmann, shows up. He wants to sell Eisman on the idea of shorting the subprime market using credit default swaps.
The same CDS as Burry was using. But Eisman's team was immediately suspicious.
Highly suspicious. Lippmann comes in with this big presentation, 42 pages, arguing housing prices have peaked, loans are going bad fast.
And Eisman's thinking, why is a sell-side guy telling me to short his market? The sell-side's job is to sell stuff, not bet against it.
It was totally bizarre. It went against everything that their skepticism told them, but Lippmann's motives were kind of complicated.
How so?
Turns out, Deutsche Bank itself was getting nervous. Lippmann was apparently being forced to get short into the CDOs internally. They were building this market for shorts, and they kind of needed outside investors like Eisman to help make it work, validate it.
So Lippmann was unusually honest about it.
Brutally honest. He apparently told Eisman and his team straight up something like, look, if you need to get out of this trade later, I'm going to rip your eyeballs out on the price.
Wow. And that honesty, weirdly, kind of convinced them.
In a perverse way, yeah. It confirmed their suspicion that the banks themselves were deeply conflicted and playing a really dangerous game. It showed Lippmann, at least, wasn't trying to bullshit them about the risk.
So that kicks off their great treasure hunt.
Pretty much. They started digging deeper, focusing on the shift they saw. By 2005, like 75% of subprime loans were these floating rate bombs, fixed for just 2 years. They knew the 2007 reset would be a bloodbath.
Their mission became finding all the hidden subprime risk and figuring out who was hiding what.
For them, it wasn't just a trade. It was about exposing what they saw as a massive systemic fraud.
Okay, to really get why Burry and Eisman were right and why banks were so wrong, we have to look under the hood of the machine itself, the whole process of securitization.
Yeah, the core engine of delusion. Wall Street's basic goal here was simple. Buy crappy loans cheap, package them up, get a high rating slapped on the package, and sell it for a huge profit. The rating was everything.
Which brings us to the rating agencies, Moody's and S&P. They were the gatekeepers, but Lewis paints them as, well, not exactly the sharpest tools in the shed.
That's putting it mildly. The sources describe the analysts at Moody's and S&P as often being folks who couldn't get the high-paying jobs on Wall Street itself. Kind of like government employees, one source said. Smart people, maybe, but not necessarily equipped for or incentivized to challenge the banks paying their fees.
And crucially, they were relying on these relatively simple mathematical models.
Yeah, models based on historical data that just didn't apply to this new world of weird mortgages. And the banks figured out how to game those models really quickly.
How did they do it? They didn't need better loans, just better ways to fool the algorithm.
Pretty much. The models didn't look at individual loan quality in detail. They looked at broad characteristics of the pool average FICO scores, loan-to-value ratios, geographic diversity.
So the banks just manipulated those inputs.
Exactly. They'd tweak the mix to hit the targets. Maybe slightly higher FICO scores here. Maybe favor loans with higher initial rates because the model liked cash flow. And the really big one, they exploited the silent second.
Remind us what a silent second mortgage is.
It's a second mortgage taken out at the same time as the first, often to cover the down payment, but the first lender isn't told about it.
Which means the homeowner has zero actual equity.
Zero skin in the game from day one. If house prices dip even a tiny bit or their teaser rate resets, they just walk away. There's no financial incentive to stay. It basically guaranteed default under stress.
But the rating agency models didn't see it coming because the second loan was silent.
Exactly. The information was hidden. The models assumed borrowers had equity, had something to lose. It was a fatal flaw, deliberately exploited.
And this gaming of the ratings enabled the creation of the collateralized debt obligation, the CDO. This is where the real alchemy happened, turning lead into gold.
Pure alchemy. This is nuts. CDO managers would buy up the absolute worst slices of those subprime mortgage bonds, the triple B rated stuff, the stuff even Wall Street knew was toxic, the pieces of shit, as the traders called them.
Okay, so they gather up all this garbage.
Hundreds of millions of dollars worth. Then they stack it together in a new tower of debt, the CDO, and here's the magic trick. They take this pile of acknowledged garbage to the rating agencies.
And the agencies say?
They look at the CDO structure, run their models based on diversity, assuming loans in Florida won't default at the same time as loans in Arizona, which was the core flawed assumption, and they declare that 80% of this garbage tower is now AAA.
80%. AAA, the highest possible rating, as safe as U.S. Treasuries.
That's what the rating meant. Rock solid. Safe enough for pension funds, insurance companies, money market funds, entities often legally required to hold only the highest rated, safest debt.
So the CDO wasn't just hiding the risk, it was actively laundering it and selling it to the most conservative, unsuspecting investors in the world.
Exactly. Monetizing the hidden risk by slapping a fake safety label on it.
And then there was AIG Financial Products. They became the key insurer for a lot of this stuff, run by a guy named Joe Cassano.
AIGFP became the ultimate bag holder, you could say. They started out insuring relatively safe corporate bonds, sensible business. But then Wall Street, in what Lewis calls stage 2 of the machine, convinced them to start insuring these CDOs, specifically the tranches built from those dodgy BBB subprime bonds.
How much did they insure?
A mind-boggling amount.
No.
Ultimately, AIGFP wrote credit default swaps insurance on about $50 billion worth of these riskiest slices of CDOs. They were taking on all that default risk.
And they must have thought they were insuring something safe, given the ratings.
Totally. Look at the price they charge. They sold insurance on supposedly AAA-rated CDO tranches, often linked to those BBB bonds underneath, for a tiny premium like 0.12% a year, 12 basis points.
Pennies on the dollar to insure against catastrophe.
It shows they completely bought the rating agency's story. They fundamentally misunderstood the risk they were taking on. By selling all these CDSs, AIGFP essentially became the biggest single owner of subprime mortgage risk in the world, and their own senior management, reportedly including Cassano, didn't fully grasp it.
Okay, so that's bad enough. Actual toxic loans being laundered. But then it got even crazier with the synthetic market.
Ah, yes. This is where the machine really went off the rails and became potentially infinite. Synthetic CDOs.
What's a synthetic CDO? No actual mortgages involved.
Correct. A synthetic CDO wasn't backed by cash flows from actual mortgage bonds. It was a portfolio made up entirely of credit default swaps referencing other CDOs or mortgage bonds.
Wait, so it's a bet on the performance of other bets. There's no actual loan anywhere near it.
Exactly. The original crappy mortgage only needed to exist so its fate could be gambled on over and over and over again in the synthetic market. It's like betting on a horse race, then creating new bets just based on the odds of the first set of bets.
And because you don't need actual mortgages, the size isn't limited anymore.
Precisely. The market could create synthetic CDOs referencing the same pool of underlying bonds multiple times. The amount of risk, the amount of betting on subprime failure or success became effectively limitless. It completely detached from the real economy.
And this created a perfect, risk-free setup for the banks in the middle, like Goldman Sachs.
Oh, it was beautiful for them. Here's the model. First, Convince someone like Michael Burry to buy a CDS from you betting short against the bonds. Okay, Goldman now has that obligation.
Right.
Then Goldman takes that same CDS contract, their obligation to pay Burry if the bonds fail, bundles it with a bunch of others into a synthetic CDO, gets the rating agencies to bless the top 80% as AAA.
And sells that AAA slice to, say, a German regional bank, which is effectively a long bet on the same bonds Burry is shorting.
Exactly. Goldman collects the premium from Burry, the short, sells the AAA tranche of the synthetic CDO, the long, to the German bank, and pockets a guaranteed fee, maybe 2% right off the top. They've made money from both sides and theoretically hedged away all their risk onto the unsuspecting end buyer.
So the whole point of financial innovation here wasn't to make markets more efficient.
It was to make them better at hiding risk, multiplying risk, and generating fees by deceiving investors globally. It all rested on that fundamentally fraudulent foundation of low correlation promoted by the rating agencies.
The assumption that defaults in different places wouldn't happen all at once.
The assumption the short sellers saw was laughably wrong. They knew it was 100% correlation. When house prices stopped rising, everything related to subprime was going down together. The ratings were just the excuse everyone needed to ignore that terrifying truth.
Okay, we've got Burry the mathematician, Eisman the moral crusader. Now for the third group, Cornwall Capital, the garage band hedge fund, as Lewis calls them, started in a shed in Berkeley.
Yeah, Charlie Ledley and Jamie Mai. Started with practically nothing, like $110,000 in 2003. Their whole angle was different. They called it event-driven investing.
What does that mean?
They believe the market consistently screws up pricing the possibility of really dramatic sudden changes, big binary outcomes, either total collapse or huge success. They looked for bets where the potential upside was massive compared to a small known downside, asymmetric bets.
And they had some early success with this, like with Capital One options.
Yeah, that was their proof of concept. They looked at long-dated options, LEAPs, on Capital One. They realized the standard pricing model, Black-Scholes, assumes smooth bell curve type outcomes.
But for a company maybe facing huge regulatory risk or accusations of fraud?
The outcome is more likely binary, right? Either it goes to zero if the bad stuff is true, or it maybe jumps way up to $60 if it's cleared. The models weren't capturing the true probability of those extreme tails.
So buying long-term options was like buying a cheap lottery ticket on that potential drama.
Exactly, a cheap ticket to financial drama. So when they stumbled onto Greg Lippman's CDS trade in late 2006, they saw it immediately through that lens.
As the ultimate cheap, long-dated option on a massive financial disaster.
Precisely. They were total newbies to the bond market, didn't know the jargon, but they recognized the structure of the bet. Paying a small premium for a potentially huge payout if the binary event widespread default happened.
But they didn't just want to copy Burry or Eisman. They looked for an even better mispricing within the system.
Yeah, they had this extra layer of insight. They figured if the whole CDO structure is fundamentally fraudulent based on bogus ratings, then the mispricing isn't just in the riskiest BBB tranche. Even the supposedly safer tranches higher up must be way underpriced for the actual risk of failure.
So instead of shorting the BBB stuff, which was getting more expensive?
Right, the premium on BBB CDS might have been, say, 2% per year by then. Cornwall looked higher up the CDO capital structure at the AA-rated tranches.
Which the rating agencies claimed were much safer.
Much safer. So the insurance, the CDS premium on those tranches was way cheaper, maybe only 0.5% per year.
And Cornwall's logic was?
Simple but brilliant. If this whole thing collapses, correlation goes to 100%, everything defaults together. The AA tranche is just as doomed as the BBB. So why pay 2% to short the BBB when you can pay 0.5% to short the AA and make basically the same bet?
So for the same amount of premium payments, they could make 4 times the bet by shorting the AA tranche, leveraging the rating agency's own flawed logic against them.
Pure arbitrage on the absurdity of the ratings, but they had a problem. You were tiny. This garage band fund managing maybe $30 million, Wall Street banks didn't want to deal with them, wanted $100 million minimum trades.
How did they get around that?
They brought in a third partner, Ben Hockett. He had some Wall Street experience, credibility, and kind of fittingly, Hockett apparently had this deeply apocalyptic worldview himself.
Like preparing for societal collapse.
Lewis writes he'd already bought a remote farm, stocked with supplies, genuinely worried about the breakdown of society. His personal pessimism perfectly mirrored their financial bet. The mainstream always underestimates the chance of really bad stuff happening because nobody wants to believe it. Hockett gave them the access they needed.
So this tension They're sure they're right, but the system is treating them like idiots, leads them to Vegas.
Yeah, Charlie Ledley and Ben Hockett go to this big industry conference, ABS East, held at the Venetian in early 2007. They were partly looking for validation, partly hoping someone would actually convince them they were wrong, give them a reason not to bet the farm.
And the atmosphere there was just peak delusion.
Absolutely peak. Lewis describes this culture of just brazen, expense account-fueled denial. That incredible anecdote about Charlie, the liberal New Yorker, getting invited by Bear Stearns brokers to go shoot Uzis at a target of Saddam Hussein, all charged to the company as client entertainment.
It just screams that consequences don't exist in this world.
It was the perfect symbol. High-risk behavior, zero accountability, zero self-awareness. But the real turning point at the conference was this speech, or rather this rant.
By John Devaney. He ran a fund that invested in this stuff.
Yeah, I was actually a conference sponsor, and he gets up and delivers this completely off-the-cuff tirade called the rating agencies whores, called the mortgage securities worthless, just laid bare the ugly truth everyone knew but wouldn't say.
How did the audience react? All these Wall Street pros?
They basically just pretended it didn't happen. Complete silence, awkward shifting. They just talked around it afterwards. Collective, willful blindness.
And for Charlie and Ben from Cornwall?
That was the moment. They realized the denial couldn't last. The self-awareness, however suppressed, was there. They figured they didn't have 6 months to slowly build their position. They maybe had 1 week before the market finally cracked.
Eisman's team was also at that Vegas conference, right? And Eisman had his own sort of crystallizing moment there.
Yeah, he had dinner with this guy, Wing Chow. Chow was a major CDO manager. His whole job was basically to take the pieces of shit, the toxic BBB bonds Wall Street created, and launder them into his CDOs, collecting huge fees based purely on the volume he managed, not the quality.
So Eisman confronts him about the risk, the morality.
Tries to. And Chow says something just astounding. He tells Eisman he loves guys like him, the short sellers.
Loves him. Why?
Chow says, quote, "I love guys like you who short my market. Without you, I don't have anything to buy." He explained that the more the shorts bet against the bonds by buying CDSs,
the more raw material Chow had to package into his synthetic CDOs to sell the AAA tranches of.
Exactly. Eisman had this sickening epiphany. The short sellers, the people trying to warn about the disaster, were inadvertently fueling the machine they were betting against. Their skepticism was creating the very swaps needed to build the synthetic CDOs that were being sold to pension funds as safe investments.
It was a completely circular, self-perpetuating system based on a lie.
A total Ponzi scheme enabled by the AAA ratings that gave everyone the CDO managers like Chow, the pension funds buying the stuff, the insurers like AIG, plausible deniability. For Eisman, that dinner shifted everything. It wasn't just about bad loans anymore. It was a full-on bet against the entire corrupted machine.
Okay, so the outsiders, Burry, Eisman, Cornwall, they saw the rot. They had the logic, the math, the moral clarity. But how did the insiders, the giant banks filled with supposed geniuses, get it so catastrophically wrong? The prime example has to be the Hubler trade at Morgan Stanley.
Oh, Howie Hubler, yeah. He was a superstar bond trader at Morgan Stanley. Made them a fortune, like $1 billion in profit in 2006 alone, trading asset-backed bonds. And he wasn't entirely clueless. He actually put on a short position himself.
He bet against some of the subprime stuff.
Yeah, about $2 billion worth of CDSs, betting against the absolute lowest, junkiest tranches of subprime debt. A trade that was almost certain to pay off eventually. He was cynical enough to see the bottom was rotten.
Okay, so far so good.
Yeah.
But that trade led to a $9.2 billion loss. What was the fatal mistake?
The cost. To maintain that $2 billion short position, he had to pay out millions in premiums every year. That dragged down his current P&L, his profits now, which is all that mattered on Wall Street.
So to make his current numbers look better.
To offset those premium costs, Hubler made the mother of all bad bets. He sold credit default swaps, sold insurance on roughly $16 billion worth of supposedly super safe, AAA-rated CDO tranches.
He went massively long, the very stuff Cornwall Capital was shorting. He sold the insurance on the top layer of the garbage pile. Why on earth did he think that was safe?
He believed the rating. And specifically, he believed the rating agency's core assumption. Low correlation.
The idea that all the underlying mortgages wouldn't default at the same time.
Right. His models, based on the agency's models, probably assumed that even if things got bad, maybe only 30% of the bonds in that AAA tranche would default simultaneously. He trusted the diversification story, the structural integrity claim of the CDO.
But the reality, as the shorts knew, was 100% correlation when the tide went out.
Absolutely. When national home prices stalled and started falling and those teaser rates reset, everyone with a dodgy loan was in trouble at the same time. Geography didn't matter. Hubler, as Lewis puts it, was smart enough to be cynical about his market, but not smart enough to realize how cynical he needed to be about the AAA rating itself. He trusted the label implicitly.
And you can see that faith in the details of his trades, like haggling over tiny amounts on deals that were about to explode.
It's incredible. Late 2006, the market is already looking shaky, and Hubler is apparently arguing tooth and nail with Merrill Lynch over 4 basis points. That's $800,000 on a $2 billion AAA CDO trade. He's fighting over pennies because he genuinely believed the principal was rock solid, virtually risk-free, just total conviction based on that rating.
And Morgan Stanley's management, did they understand the massive risk Hubler had taken on with that $16 billion long bet?
Apparently not clearly. The way the risk was reported internally seems to have obscured the true nature and scale of that offsetting long position. Senior management, maybe even the CEO, John Mack, kept talking about their great structural position in the market, likely unaware of the time bomb ticking on Hubler's desk. That complexity was a feature, not a bug. It hid the risk.
So when things really started to unravel and Deutsche Bank Lippmann's desk saw Hubler's position hemorrhaging money, they offered him a way out.
Yeah, they saw the $16 billion long bet was going toxic fast. They apparently offered Hubler the chance to unwind the whole thing, take a loss of maybe $1.2 billion, and just cut the bleeding.
And Hubler said
He refused. He argued about the price. He thought Deutsche Bank was lowballing him, that the bonds were still worth more. The guys at Deutsche Bank apparently realized Morgan Stanley wasn't just being cagey. They genuinely didn't understand how bad these synthetic CDOs were.
So because Hubler haggled over the price instead of just getting out.
The losses just kept mounting exponentially as the market vaporized. That $1.2 billion potential loss turned into an actual loss of $9.2 billion, one of the biggest single trading losses in history.
And when CEO John Mack had to explain this to the public,
his explanation was a masterpiece of corporate speak, basically admitting he didn't fully grasp it. He talked about an error in judgment incurred on one desk and hedges that didn't perform adequately. He couldn't articulate the actual mechanism of the failure, the correlation error, the synthetic nature, the sheer scale of the long bet, because the system was designed to be incomprehensible, even at the top.
But while Hubler was blowing up, Michael Burry was finally getting his proof. When did he know Wall Street was finally acknowledging his reality?
It started becoming clear in late 2006, early 2007. The ABX index, which tracked those crucial BBB subprime bonds, started to plummet. That was the first public market signal that the rot was real. Wall Street firms started to panic internally, realizing they were sitting on mountains of this stuff.
But the real moment for Burry was when his counterparties, the banks he bet against, changed their tune.
Yeah. In June 2007, after nearly 2 years of the banks marking his CDS positions against him, his Morgan Stanley salesman calls him up. Says the firm wants to make sure his marks, the value of his shorts, are fair. The next day, Goldman Sachs does the same thing.
And Burry realized.
He realized it was the first time they weren't trying to screw him on the marks to hide their own problems. Why? As Burry put it, they were finally moving the marks accurately because they were getting in on the trade themselves. They were finally trying to short the market too, trying to profit from the collapse they could no longer deny.
That was the validation. But it was way too late for the system as a whole.
Way too late. By the end of 2007, Lewis notes, over a third of the specific bond pools Burry had bet against were already in default. The total losses on U.S. subprime stuff were already heading towards $1 trillion. The avalanche had started, and then 2008 hits, and it just accelerates. Total chaos. Lehman Brothers goes bankrupt in September. Merrill Lynch forced into a sale to Bank of America. And AIG. AIG needs a massive government bailout just to survive.
The speed was terrifying. And even for the guys who got it right, the short sellers, the emotional impact was huge. Like Danny Moses, Eisman's trader.
Yeah, he described having this panic attack around September 18th, 2008, right after Lehman failed, just overwhelmed by the sheer volume of catastrophic information flooding in. He said it felt like man versus nature, a feeling he hadn't had since 9/11. They'd won, but the victory felt like witnessing the apocalypse.
And Eisman's team, that same day, they were sitting on the steps of St. Patrick's Cathedral in New York.
Yeah, just watching people walk by. They'd nailed the call, years in the making, but there was no celebration, just this grim realization.
What did they realize?
Porter Collins, one of the team, said they looked at the crowds and thought, these people are either ruined or about to be ruined. And Eisman had this cold clarity. The investment banking industry is fucked. He saw it had been built entirely on that circular Ponzi scheme of synthetic CDOs, and the whole thing was just imploding.
But the collapse itself is almost secondary to the response, right? The government intervention, the bailouts.
Yeah.
That's the enduring legacy.
Absolutely. That's the point Lewis and the sources consistently hammer home. The government stepped in, but how? They protected creditors, bondholders, the counterparties, and they transferred the colossal losses from the Wall Street firms that caused the mess onto the U.S. taxpayer.
Like with Bear Stearns.
Bear Stearns fails, bondholders get paid back pretty much in full, stockholders get wiped out, okay? Yeah. Then Lehman is allowed to fail, chaos erupts, proving there was no real plan for winding down these giant interconnected firms orderly.
The government claimed they didn't have the authority or the tools.
But then suddenly they find $85 billion, later $180 billion, to bail out AIG.
And that AIG bailout money went straight through AIG.
Do its counterparties on those CDSs.
Right.
Especially firms like Goldman Sachs. Remember AIG sold insurance on all that crap? Goldman was holding billions in those CDS contracts.
So the $13.9 billion AIG technically owed Goldman.
Was paid off 100 cents on the dollar by the U.S. taxpayer. Taxpayers bailed out AIG so AIG could make Goldman whole on bets that Goldman itself had helped structure and sell and was also betting against.
That's the definition of moral hazard right there.
It sent a clear message, solidified by the TARP bailout funds that followed, often with few strings attached. Lewis calls it the creation of a new regime. Free money for capitalists, free markets for everyone else. Risk gets socialized, profits stay private.
And Lewis connects this back to a fundamental shift on Wall Street decades earlier, interviewing John Gutfreund.
Yeah, Gutfreund, the guy who took Salomon Brothers public back in 1981. He pinpointed the root cause, the shift from partnerships to public corporations.
Why was that so crucial?
As a partnership, the partners' own money was on the line. They would never have leveraged the firm 35-to-1, taking insane risks because it was their personal wealth at stake. Once Salomon went public, the risk shifted to the shareholders. Gutfreund said it bluntly, when things go wrong, it's their problem.
That created the incentive structure for disaster. Traders and managers could take massive risks, game the ratings, chase short-term bonuses,
knowing that if it all blew up, they'd likely walk away with their millions, and the shareholders, or ultimately the taxpayers, would eat the losses.
So the real failure wasn't necessarily letting Lehman fail.
It was letting the Lehmans and Bears and Citigroups and AIGs operate with that level of leveraged, opaque risk in the first place, and then rescuing the system in a way that didn't fundamentally punish the risk takers or change the incentives.
So wrapping this up, we saw these three groups of outsiders who saw the crash coming. Each had a different path to the truth.
Yeah, you had Michael Burry, the isolated numbers guy, pure logic. Steve Eisman, the moral crusader, driven by outrage at the fraud. And Cornwall Capital, the philosophical outsiders looking for mispriced options on disaster.
And the common thread wasn't some specific financial skill, it was. They were all kind of oddballs, insulated from the groupthink.
Exactly. They were outside the overwhelming consensus, the culture of denial we saw in places like that Vegas conference. That insulation allowed them to question the idea that house prices only go up, that AAA ratings actually meant safe.
The scale of the loss was immense, over $1 trillion just from U.S. subprime assets. But the big lesson isn't just about the loss.
It's that the system didn't self-correct. Logic didn't win. Free markets didn't discipline the bad actors. It was saved by massive government intervention.
An intervention that arguably reinforced the too-big-to-fail status of the very institutions that caused the crisis.
Which leads right to Eisman's lingering fear, the unfinished business. Did we actually fix the underlying problem or just patch the cracks?
That's the core fear.
It's still the sheer volume of opaque, unregulated speculation, especially in the derivatives market, the side bets. It's not just about how big the banks are. It's about this invisible, interconnected web of swaps linking everyone together.
Lewis mentions that terrifying possibility a bank with maybe only $1 billion in capital might have $1 trillion in CDSs outstanding.
Right. And the chilling part is, quote, no one knows how many there are, and no one knows where they are. The opacity is still there.
Which leaves us, and you the listener, with a pretty unsettling final thought. If the last crisis happened because risk was hidden in complexity and these opaque side bets, is the financial system still too big to fail? Not just because the banks are huge, but because the potential fallout from all those hidden, unquantifiable bets on its failure is just too massive and too unknown to contemplate.
If you can't even measure the risk accurately, how can you possibly manage it? That seems to be the question still hanging over us.